Welcome to Phillip Futures webinar. I'm Joyce Liu, Investment Analyst with Phillip Futures. This is the first of the series of monthly gold futures webinar where we will be discussing current market events and trading opportunities in the gold market. To kickstart this series, today we will spend some time to introduce and compare the different gold futures contracts available for trading. Disclaimer: this presentation is solely for education purposes only. It contains the opinion of the analyst but does not constitute investment advice. Here is the agenda for today. In order, we will be discussing why gold market dropped more than 10% in 2 days. Discussing the near-term breaking news in this issue. Spot gold prices dropped a stunning 15% in 2 consecutive trading sessions, Friday last week and yesterday. This is in line with the extremely bearish picture we have been painting since late February. The collapse began on April the 12th. Spot gold prices dropped more than 5% in 1 day from US dollar 1560 per troy ounce at market open to 1478 at market close, and a further 8.5% yesterday to finish at 1353. Meanwhile, COMEX Gold, most active June futures contract, dropped 3.8% from 1561 at market open to 1501 at market close, and a further 9.4% yesterday to end at 1361. This entire gold market collapse, in our opinion, is a trilogy that started earlier this year. In chronological order, increasing signs of economic recovery in the US sets the stage for gold fund outlook. Since the financial crisis of 2008, gold prices have been upbeat for a combination of reasons. Firstly, its status as a safe haven asset makes it desirable during crisis and recession, when investors are jittery about almost any other markets. Secondly, the negative real interest rates make higher yielding assets such as stocks and gold more attractive. Finally, the large amount of money pumped into the US economy by Federal Reserve remains in the banks and among the rich and more credit-worthy borrowers, instead of serving its intended purposes of encouraging spending and long-term investments. As the economy picks up, firstly, investors' confidence in the economy's outlook improves. There is less need for safe haven assets. So investors start looking for other good yielding financial assets for investment. Gold, a non-dividend yielding asset with prices that many say are inflated, becomes less desirable. At the same time, as the prospects improve and having cleaned up a large portion of their balance sheets, banks become more willing to lend out the large amount of money they have amassed through years of bond buying by the Fed. As unemployment drops, people are more willing to consume, especially in the low interest rate environment, and corporates start investing in long-term plans. Money that was once parked in safe haven gold markets start flowing out into spending and investing. As such, we have a bearish backdrop for the gold market, as seen by the long downward trend channel since October last year. But what triggered the sell-off is likely the leaked Cypriot plans to sell €400 million worth of gold for its central bank to raise funds for its crippled banking system. The gap in its banks that must be covered is rumored to be much bigger than expected. Although €400 million converts to only about 10 tons of gold at market prices at that time, the move sparked fear among investors that other debt-ridden Eurozone countries may similarly be coerced into selling off their gold reserves to fund their own bailout. Countries such as Portugal, Italy, Greece, and Spain have hordes of gold reserves compared to the mere 13.9 tons owned by Cyprus. This is a very plausible scenario because selling gold is a politically more viable option than accepting austerity measures that further drags their domestic economies and burdens their citizens. But what exacerbated the sell-off to become a colossal collapse of no return are the automatic stop losses that are triggered by brokers, banks, and trading houses, especially when prices dropped through key technical levels, which prompted further selling. In addition, gold futures trade on margin and trigger margin calls when prices move in the opposite direction. This forced investors who are unable to put up margins in time to liquidate their long positions. So what we've just been through is a quick view of the latest important event in the market. The most important question is, going forward, what is the outlook? To address this question, we will be studying the technical charts for spot gold market, which the futures across all exchanges are closely tied to. This is the daily price chart for spot gold. As mentioned just now, gold prices have been trading in a downward trend channel since late October last year. Prices showed increasing signs of weakness towards the end before breaking down impulsively. Unlike previous times, gold prices failed twice to close in on the upper channel after rebounding off the lower channel. Hence, the bearish breakout was within our expectations. At current price levels, there are no clear signs of gold prices bottoming, whether on the daily chart or hourly chart. Hence, we prefer to look out for key support levels to come. We put our immediate support level at 1310, breaking which the next level is likely to be found at 1260. However, with some optimism in the Asian markets today, 16th April, if gold prices jump when US markets open, we can look forward to some sideways or upward correction in the short term, but big picture outlook remains bearish for now.